The US dollar is experiencing a remarkable comeback. It has climbed to heights not seen in over a year. This surge is driven by a confluence of factors, both domestic and international. Investors around the world are flocking to the dollar's perceived safety. This is especially true in times of global uncertainty. The US economy, while not without its challenges, remains relatively robust. This makes the dollar more attractive to investors seeking stability. When compared to other major economies, the US appears to be on firmer ground. This perception is a key driver of the dollar's current strength. The current global landscape is fraught with geopolitical tensions and economic uncertainties. Investors are naturally drawn to assets perceived as safe havens. The US dollar, backed by the world's largest economy and a stable political system, fits this bill perfectly. This makes it a magnet for investors seeking to protect their capital during turbulent times. Geopolitical tensions, particularly in the Middle East, are playing a significant role in the dollar's resurgence. The recent conflict between Israel and Hamas has sent shockwaves through the region and beyond. This has injected a new level of uncertainty into global markets, further boosting the dollar's appeal as a safe haven. The conflict has also raised concerns about potential disruptions to oil supplies. The Middle East remains a crucial source of global oil production. Any threat to this supply chain sends ripples through the global economy. Investors tend to react to such uncertainty by shifting their assets to safe havens, and the dollar is a primary beneficiary of this flight to safety. The situation is further complicated by Iran's involvement in the conflict. The US has imposed sanctions on Iran, adding another layer of complexity to the geopolitical landscape. These sanctions have limited Iran's ability to export oil, putting upward pressure on global oil prices. This, in turn, further supports the dollar, as oil is priced in US dollars. Rising oil prices, fueled in part by the Middle East tensions, have a complex relationship with the US dollar. On the one hand, higher oil prices tend to benefit the dollar. This is because oil is priced in US dollars, so when the price of oil rises, demand for dollars increases. This is a boon for the US currency. On the other hand, rising oil prices can also fuel inflation. This is because oil is a key input in many goods and services. Higher oil prices translate into higher production costs, which can lead to rising consumer prices. This can erode the purchasing power of the dollar, potentially offsetting the benefits of increased demand. The US Federal Reserve is closely monitoring this delicate balance. The Fed is tasked with keeping inflation in check while also supporting economic growth. It walks a tightrope, trying to manage the impact of rising oil prices on the US economy and the dollar. The US labor market remains a source of strength for the dollar. Recent jobs reports have exceeded expectations, indicating a robust and resilient economy. This positive economic data further bolsters the dollar's appeal to investors seeking stability and growth. Low unemployment rates and steady job creation paint a picture of a healthy US economy. This is in stark contrast to many other developed economies, which are grappling with sluggish growth and high unemployment. The relative strength of the US economy makes the dollar an attractive investment for those seeking to capitalize on growth opportunities. This positive economic outlook is further supported by strong consumer spending. American consumers, buoyed by a strong job market and rising wages, continue to spend. This robust consumer activity is a key driver of US economic growth, further reinforcing the dollar's position as a global leader.